Hi, thank you for joining us. My name is Bruce Norris, and our guest today is Craig Hill. Craig, welcome.
Thank you.
Craig's the person you'll be talking to if you call for a loan at the Norris Group or if you have an interest in trust deed investments. And today we'll talk about investing in trust deeds. Craig, we've known each other now for over 20 years, but the idea of investing in trust deeds is still foreign to a lot of people. We get in front of audiences and we ask them about trust deeds, and we just had one a couple of weeks ago. Asked how many people invested in trust deeds, 100 people in the audience, less than 10 hands. So
Yeah.
it's still not the most common vehicle for their money to land on.
Yeah, it's just it's surprising in some ways because, like, say, comparing trust deeds, to stocks or something of that nature. I mean, a trust deed, simply put, is like anybody that's bought a house or knows somebody that's bought a house and has taken a mortgage. I mean, that's essentially what investing in a trust deed is. The difference is you're on the other side. So instead of paying the money, borrowing the money and paying the money, you're actually lending the money and then receiving the money. So a trust deed is actually a very simple concept to understand.
I think most people are so used to the stock and bond world that this is just, for whatever reason, they haven't landed here and said, okay, that's a viable alternative. Who ultimately ends up being a trust deed investor? What does their MO look like?
Yeah, I would say most trust deed investors are people that, regardless of their age, are probably people that have already, let's say, have made their million or millions. They've kind of made the money that they have. Now they're in more of a position, let's call it passive, where they certainly want to get a decent yield on their money, but they're probably more concerned about principal protection than maybe taking any more major risk. They feel like they've gotten to a point where now it's just kind of managing the money.
Mm-hmm. One of the things that when I got involved in trust deeds is that it seemed like it was a natural extension to something I already knew.
Right.
I understood real estate appraisal or value and that type of
Right.
thing. And so if I was going to make a trust deed investment, it was comforting that I could take what I already knew and I could stand in front of the house and say, okay, I'm a lender at $140,000 on this $210,000 house.
Right.
What are the likelihood I'm going to get paid back? And if I don't get paid back, what's the likelihood I'm going to retain my principal? And it was kind of that concept where I could understand it I had all the tools that I could already understand it. When
Right.
somebody says, would you like to invest in a bond attached to whatever, and you go, I don't know that world.
Right.
And it's interesting that most money flows to that world, but I doubt that very many people could understand it as easily as they could what a trust deed is.
Oh, absolutely, because you're dealing with concepts that people already understand, as you mentioned. Everybody either has owned a house or their parents have owned a house or somebody that owns a house, and everybody knows that house has a value. And people talk about their values all the time, so that's something that is a concept that's familiar with them. Then when you're talking about lending 70% of that value, that's maybe what your trust deed would be.
Right.
It really is an investment that once you understand what the security is and what you're doing, it really comes down to just very simple math. I mean, it's not much more than just a real simple math equation, and you do it and you put yourself in a position where you're very well secured.
A trust deed investor is, they're wanting security, but there's a really good benefit for a trust deed is that you get a monthly check.
Yeah, it's very passive income. It's just a check that you're going to get on a monthly basis. And being the trust deed investor, you don't have to worry if the air conditioner goes out. You don't have to worry if the tenant moves out.
Do you find that most trust deed investors they cross over to real estate ownership with some of their money? They own rentals and trust deeds, or they have sort of separated the two?
Yeah, quite a few will do both.
Okay.
I would say it's a mixed bag. I mean, there's people like myself that might only be more the trust deed just because of our personalities, and like yourself, who would do both. There's a lot of people that have had rentals and they've held them, and when there's times of appreciation, maybe they've sold them, and now they're more interested in the trust deed world. So it's definitely a mix that there are people on both sides.
I think what you sort of match investments with your personality, like what you were just saying.
Yes, absolutely.
And for me, it drives me crazy for me to be able to look at something, if I own a stock, and I could see what it's worth every second of the day.
Right.
it drives me crazy. I'm not really geared toward that. So if I have a home ownership, there's not an appraisal going on like a ticker tape on the front lawn.
Right.
And the trust deed is kind of boring. It's one of the things, when we were talking about when people have a trust deed in their retirement, there was going to be some evaluation process where you had to evaluate, like, what's the trust deed worth? Well, it's pretty easy. It's an 80 grand trust deed and it's worth 80 grand.
Exactly. It's going to be worth $80,000.
Yeah, it's not going to go anywhere, and it's going to spit out this much check 99% of the time plus. It's going to send you a check every month, and you will forget that you have an investment. It's just simple.
Yes.
And that, for me, I've been on both sides of those fences, not just the trust deed, but the rental side. So a couple months ago, we had a big windstorm in Riverside, and I had the rental that knocked the fence down. Had I had the trust deed, I would never have known of that occurrence.
Right.
I would have just gone on and got my check. Because I owned it, I had to, get the fence guy out there for a couple grand and fix it.
Exactly, and we can see how comfortable people get with trust deeds because it doesn't take too long. Nobody ever starts with the maximum amount in trust deeds, but they might start with 1 or 2 or 100,000 or something. But it doesn't take them long to see the investment and how comfortable they're with it. And it's almost funny how many people make a call after that, and it's almost like they want to place an order on another trust deed. Like, we have them on the shelf, and they just can't wait to get that next one. Unfortunately, it doesn't work that way all the time, but it really is very pleasant for us, the familiarity that comes very quickly with trust deeds and how much people want to up their investment in that type of vehicle.
I was recently on a cruise, and I was eating dinner with people that obviously had stock investments, and the stocks were going up 500 points and down 800 and 500.
Right.
I was just driving me crazy, and I was sitting there going, I'm really glad I don't have that part of that world anymore. Right. Because it does drive me crazy. So I enjoy that my trust deeds are really on the boring side, and it matches my personality. When somebody has their first introduction to hard money, either as a borrower or a lender, we're going to be talking about rates they're not hearing in the newspaper.
Right.
So if I have money and you're telling me I can get a certain percentage, I'm thinking, well, who are you loaning to that, why are the rates high?
Right.
Why are the rates high?
Well, the rates are higher because you're you're using private individuals to fund the deal, so there has to be an incentive to do that. I mean, that's the answer to that. And from the borrower's point of view, I think people would be really shocked if they could see the credit histories of most of our borrowers, the amount of cash primarily that most of our borrowers have. We're lending to really good borrowers. It isn't the client that we're lending to that isn't good. It's usually the situation isn't what maybe would be considered bank worthy. And there can be ridiculous reasons for that.
Right.
One, if they have over a certain amount of properties, now all of a sudden they're not bank worthy.
Right.
And so somebody brand new is more bank worthy to them than somebody with a 10-year track record. Well, that doesn't make sense. And then also the condition of the property can make them not bank worthy. So what people have to understand when they're getting a higher yield is it isn't a reflection on the client. It's a reflection on the property or maybe circumstances surrounding that situation that have created that. It's not the fact that the borrower necessarily is an unworthy borrower.
Yeah, we had, during the time when credit was really, really tight, we definitely have had people that have millions of dollars in the bank with great FICO scores borrow money from us because there was no access to other money.
Yeah, it's almost shocking that they couldn't get bank money. I mean, there were 2 or 3 clients that are in that category.
Right.
I mean, what you'd call AAA times 2
right.
that could not get bank financing.
Yeah, and you just go, okay, well, they don't want to loan to that group, period. You're just...
Right, yeah, I mean, and it could be as simple as that, like we are not lending to investors anymore.
Yeah, and that was in place for quite a while. But most of the time, it's the product. It's that you've got a house that's in a decent neighborhood, but that particular house is minus a kitchen, or it's got it's got all the work it needs to be done that the lender, that's the standard lender, the standard B of A lender is looking at that going, I can't loan on that right now. And
exactly.
So that's the opening for our world to show up.
Right.
The hard money lender. We've landed on a certain product type. So if somebody's putting up money for a trust deed, they're going to have a trust deed against what type of asset almost 100% of the time?
Almost 100% of the time they're going to have an asset that's a single family residence. We do some units, smaller units. We don't do any commercial. We don't do any land. We won't do any, say, 24 unit apartment buildings. And most of the loans we do tend to be in the $100,000 to maybe $500,000 range. We
Right.
have done some higher ones, but we tend to stay in a niche that's very, very just common. It's just not anything out of the ordinary. It's just very basic homes and pretty much basic dollar amounts.
Oh, and I know you made that decision a long time ago, but why is that like the safe pocket, if you will? Is it because that we would know what to do with the product should the worst case scenario happen?
Yeah, you're dealing with a lot more known result regardless of what happens.
Right.
You're dealing with a lot less volatility. Just as an example, one product we don't do that's very popular right now, if somebody calls us with a $1 million buy that needs a $1 million renovation and then they're going to sell it for $3 million, we just won't do that because we feel the risk is too high.
Right.
Because so many things have to be right for that to happen. And if the market were to change, as an example, if it was the end of 2013 when they started down that journey, that wouldn't have been a good result. So we try to stay away from things that are a little too volatile and things that might have a little less fluctuation and are a little more of a known commodity to us.
Okay. It also, we try to match, there's times that if we go out of a box that we're comfortable with or normally don't do, it's because it's the expertise of the person saying, let's say just a fire damaged house. That would be a very rare loan.
Right.
Unless we're dealing with a guy, that's all he does is he does this for the last 20 years.
Exactly. I mean, a lot of our people have numerous experience in that type of product.
Right.
We wouldn't do a fire damaged house for somebody if it was their first deal.
Right.
Just like a lot of our clients, when the market is escalating, it's a very good strategy in some little more higher end areas to maybe buy and add square footage. Okay, we certainly would do that, but we wouldn't want to do that with a client that didn't have any experience doing it. So there are exceptions to the rules, but usually those exceptions involve very experienced people behind them.
Our trust deeds are always in what position of seniority?
We always do first trust deeds.
Okay.
That's all we're going to do. That's, as a company, that's all we've ever done, and that just is really, if you're going to invest in trust deeds, I think that's where you should be.
The problem with having a second trust deed, and the reason it could be attractive is maybe it's got a great yield.
Yeah, seconds can be attractive for two reasons. One, the yield will be higher, and two, a lot of times it involves a smaller dollar amount.
Right.
But that smaller dollar amount can kind of come back to bite you because usually you're going to invest a smaller dollar amount because you don't have a larger dollar amount.
Right.
Well, the person in second might be responsible for bringing a first current, paying property taxes. They might have a lot of expenses, and if they aren't prepared for that, I mean, their investment might turn into double what they invested.
Right.
And they might not have that, and that would jeopardize the whole investment.
Exactly. They could lose it if
Yeah,
they first
absolutely.
had to foreclose. Okay. When we do trust deeds, we generally have an individual trust deed that's available, and one person takes it, and they're going to be the sole owner of it. How does that differ from other people's process?
Yeah, I think we're probably the last company that does a large amount of trust deeds that still does the one investor, one trust deed. A majority of people have gone more to the pool route, where you're just investing in a fund that invests in trust deeds. And once again, we've always said this with pools work until they don't. And by the time you're aware of a pool that's not working, you usually have a large problem. If you're in an individual trust deed, you would know after 30 days if you didn't get your payment.
Right.
Okay, so now all of a sudden you're aware of something may or may not be wrong. It may be as simple as it's in escrow and it's going to close in 15 days. Or it may be a situation that has to be taken on further. But when you're in a pool, you really don't have much control over your investment.
What's the advantage of a pool for the broker? Why would they want to do it?
Well, there's a couple advantages probably for the broker on a pool. One, I think you can get a more favorable cost center to them.
Okay.
So I think it's maybe a little more profitable than how we do it. And two, if things are slow, and I'm certainly not saying that everybody does this.
No.
It's just the temptation can be there, because I've seen this throughout the time I've been doing loans in all phases. But if things are slow and you have a pool of money, it only makes sense that that money has to be working. So you might tend to step outside of your box
Right.
if things are slow. One thing about the Norris Group, since 1997 and 2000 and on, a deal that was good in 1999 is still good today.
And a deal that wasn't good is still
Is
not
still
good
not
today.
good. No matter how slow or busy it is, a trust deed that's good is always a good trust deed.
When you have a pool of money, you really don't have to ask if somebody wants to fund that trust deed, right? It's already in your control to fund it.
Absolutely.
And that's very different than a one-person trust deed, because you always have the right to go see the structure or see the investment and say, I feel uncomfortable with that.
Yeah, absolutely. At the very least, with our clientele that invest in trust deeds, they're going to get a copy of the appraisal emailed to them. So, I mean, they're going to have a full appraisal. They're going to be able to look at this, and they're going to be able to understand, okay, here's what I'm lending on, and here's how much I'm lending. And if they want to, they can even drive by and take a look at it.
And with a pool, you'd probably get a monthly report saying we have several $1 million of new trust deeds, and here they are. But they're already after the fact. It's
Right.
already, you're in there.
Yeah, you're not involved in the decision-making process.
Right. Loan to value, where are we at right now for the different programs?
Right now, we're about 70% loan to value for our maximum.
Okay.
We don't do anything higher than 70. So probably most of the trust deeds fall between 65 and 70, I would say, maybe even 60 to 70, depending on different situations. We always will ensure that the client has a certain amount of money in.
Right.
So if that criteria is not met at 70%, then it's going to be a lower loan to value.
Okay. What would be the criteria for a 70% LTV?
Well, at 70%, you're going to probably have a pretty conforming property. Most likely that's going to be a borrower that we're familiar with,
Okay.
has done a lot of business with us.
Okay.
It's going to be a property that is easy to hit the mark in terms of value. And what I mean by that is there's a lot of areas where Rick Solis, who is our appraiser, he can go out there, and I mean, he can almost line them up and tell us, okay, this house is worth $300,000.
Yeah, because it's almost a model match to the comps.
It is.
Yeah.
There's going to be other scenarios, Bruce, where Rick might go out there and his initial thing is these comps are all over the board.
Right.
If the comps are going to be all over the board, we're not going to maximize that trust deed, because we don't want to maximize to the wrong number. And that could be a danger.
I think, especially if you attend a real estate investment club and you hear sometimes various hard money lenders get up and do their spiel, that you kind of get the impression that no one ever says no.
Yeah, I think we're the anti-hard money lender
say
when
no
it
a
comes
lot.
to, we say no a lot, because our business model has always been create a program where we can lend to the best borrowers.
Right.
We only want to say yes if it's something where we feel it's going to be good for both sides.
And I know there's times where you have somebody that will put in more money. So they bought something at 90% that needs, 30 grand worth of work and just has to close it, and will put 30% down.
Right.
And they don't get a loan because you're looking at it going, you can't do that. It's, we can't participate in it because it isn't going to work.
Yeah, we really won't. We can always make a safe loan.
Right.
You can always create a number where the loan is safe.
Right.
But we would choose not to do a loan where we feel like the borrower is making a mistake. That's just, we would prefer that they really get out of that deal and just look for something else.
What's rewarding is sometimes after people feel like we've gotten in the way or prevented their progress, that we circle back around and go, oh my gosh, I'm so glad you said don't do that one, because then the truth comes out, or they realize it was not as represented.
Oh yeah, no, I think that's one of the rewarding things is knowing that you've really helped a lot of people, especially that maybe might be first-time people.
Right.
They have a tendency really to want to do a deal so bad that they might make a mistake. And conversely, that can happen on somebody that wants to make an investment also. Mm-hmm. They can want to lend their money so bad that they're going to make a mistake, and we always serve to be that level head that tries to keep both parties from doing that.
I think when people invest in our trust deeds, they really don't know what goes on before they're even contacted first. I mean, there's
Right.
a filter system in place that has gone through the 6 deals that didn't make the cut that you didn't have to get bothered with, and the one that you're going to get is already teed up. We already have gone through the due diligence and know it's
Right.
going to work.
Exactly.
And I don't know how anybody would have appreciation for that because they wouldn't know, but that I can just say I've watched it over 20 years, and it goes through a process before there's a yes answer. That's makes it as safe as it can get.
Yeah, and they don't. I don't think they appreciate it on the first one. But after, I'll just use an example of an investor we have, Candace, who's been with me even pre-Norris Group, if you will. Just
Right.
been a friend and a long time. I just remember deal after deal, accountant after accountant, year-end taxes, telling her how risky trust deeds were.
That's right.
And after about 10 years, he finally just told her, I don't know what you're doing, but keep on doing it. So I don't think people have an appreciation of the initial deal maybe, but when they see the track record over the time and results, they realize that that's just not typical for trust deeds. And I think they have an appreciation and a realization that the Norris Group must be doing something that goes a little bit beyond what other companies do.
We've just started this 6.9 program for the California investor
Yes.
borrower, and so we have, we're asking for the support of the trust deed investor.
Yes.
And that's a yield that's different than most trust deed investors, and yet we've already had millions of dollars accept that would be a safer decision to stay with us at that yield than try to do something else.
Yeah, it kind of came down to the point where we were getting so many payoffs in our rental program
Right.
that so many people were having money and getting a zero yield.
Right.
So with Aaron's help on what was available in the marketplace, and then myself also talking to a lot of existing clients, we realized that there was some flexibility there because people with us kind of just want to make sure they get from one point to another safely.
Right.
So we were fortunate enough that probably about 75% of our existing clientele said yes, they would take the 6% because they liked the fact that it was going to be the same product.
Right.
We made a decision to lower the yield and keep borrowing to the same clientele that's allowed us to have the track record that we have versus maybe increasing the risk to try to keep everybody's yield up.
Right.
That's just something the Norris Group has never done.
Yeah, as a company, we don't want to chase yield when the yield has in fact changed. Our industry has changed. It has new participants.
Right.
But this gives us the flexibility to retain the best people who want to do business with us if we can even get close to the programs, and now we have one that we can.
Exactly, and it comes down to, for us, we have possibly a $40 million pool of money that's been involved or even larger in our rental program.
Right.
Well, we came up with something where we could keep a large portion of that money still busy. It just doesn't do us any good to only keep $5 million of that money busy.
No, and it doesn't do me as an investor in trust deeds to be waiting for that
Right.
10% trust deed. If I wait for 4 months, I've gotten 6, and I'd rather just say, you know what, if that's what it is, it is. 3 years
Yeah.
later, we'll make a new decision.
Yeah, and people really have to realize that 6% over 3 years on all of your money for 3 years straight is going to equal a lot more than 9 or 10 in and out half of that period. It's just, yield is one thing, but the amount of money you make is something else. And we still feel that this is going to be a very good way to keep return for our investors.
And the safety involved in who we're getting to loan to, the product that naturally lends itself to that type of financing has cash flow from day one.
Exactly.
And as you go forward, the value can increase or the renting can increase and make that even safer. So we feel like this product, this trust deed will mimic that 9.9 in success as far as payment history and successful business creation for both ourselves and for people that have money waiting for a trust deed to fund.
Yeah, absolutely. And it's only about 30 days into it, but it's already proving that out.
Yeah, we've done obviously a lot more loans, and there's a buzz about it. It's been
Yes.
really nice.
Yeah, within the community of good buyers, that's what's great.
Yeah. Well, Craig, thanks for joining us.
Thank you.
You can check out our trust deeds at tngtrustdeeds.com. Thanks for joining us.